So welcome to Chapter 9. We are moving away from talking about payroll and we're going to start talking about sales and cash receipts where we're selling inventory, which is a physical good. So first of all, let's talk about what inventory is and what inventory isn't. Inventory is the goods, the physical product that we are selling to customers. Now, a lot of times I'll hear people say, well, our office supplies inventory is getting low or something like that. Office supplies aren't inventory. You're not selling those office supplies to a customer, therefore they're not inventory. Inventory is specifically what we're selling to a customer. You may call it merchandise, you may call it merchandise inventory. So it's the stuff that's selling. It's not the stuff that we're using in the business. It's the stuff we are selling to customers. Think if you go into Target, it's all the stuff that's on the shelf available to sell. Now, inventory is an asset, and we have two different options as far as what kind of system we use to track our inventory. Today, pretty much everybody uses a perpetual inventory system. This is a computerized system that continually updates our levels of inventory. Before that, or if you don't have a computerized system, you use what we call a periodic inventory system. We're not going over the periodic inventory system because it's not very common. Not very many people use it anymore. So we're just going to go over the perpetual system. Now, cost of goods sold is an expense account. Notice that it's an expense account. It's pretty much the only expense account we have that doesn't end in the word expense, but it's where we put the inventory after we've sold it. So remember, an expense is an asset that's been used up in the production of revenue. So we own this inventory until we sell it to a customer, and then we're going to move it out of the inventory asset account and move it into the cost of goods sold expense account. So remember, accountants are not real creative. Cost of goods sold is the cost of the good that we sold. So if we're selling t-shirts and we bought these t-shirts for $5, then we're going to record cost of goods sold at $5. That's how much the good that we've just sold cost. So one of the numbers that we need to know is what we call gross profit. You may also hear this called gross margin. Gross margin and gross profit mean the same thing. For those of you that have taken economics, you talk about lots of margins in economics, not the same kind of margin as you talk about there. So gross profit is just our sales revenue, the selling price, minus the cost of goods sold. So it's the profit that we made just on that sale. It's not overall profit because we've still got lots of other expenses we need to subtract out. But if it's just the profit that we made on that sale. So here we have an example. Walmart sells a TV for $500. It cost them $300. So our sales revenue would be $500. Our cost of goods sold would be $300. So that would give us gross profit of $200. And then we would list out our operating expenses and come to our net income or net loss on our income statement. So now let's assume that we're the buyer here. So we're again Walmart. We bought some TVs from Sony Corporation, pardon me. We paid $7,000 for those with what we call terms 210 net 30. So what does 210 net 30 mean? Well, first of all, when we buy the inventory, we're going to increase the inventory account by $7,000, and we're going to increase accounts payable because we're told we bought them on account for $7,000. So we are going to do a journal entry where we debit inventory, credit accounts payable for $7,000 because that's how much we owe for this inventory. And we bought it on account, and anytime we are purchasing something, remember it's accounts payable. So we've increased our asset, we've increased our liability. We still need to talk about this 210 net 30. All right. Now, not all things that we buy will go into the inventory account. Only the things that we buy that we plan to turn around and resell to customers go into the inventory account. So if it's stuff that we're going to use in the company, we're going to call that supplies. If it's equipment that we're going to use in the company, we're going to put that in equipment. Those are things that are not available for sale to customers. So those don't go into inventory. Only the stuff we're going to sell directly to customers goes into inventory. So here we're told we bought some shelving equipment. We're going to put that in the shelving equipment account. Now, we noticed that when one of the TVs we bought was damaged, and so we need to return it. So this is one of those TVs that we had bought for the total of the $7,000, but it was damaged, so we're going to return it to the supplier. The supplier is going to give us what's called a debit memorandum, okay? And in that case, since we haven't paid for the TV yet, we are going to debit accounts payable to reduce our liability. So hopefully you've got your T accounts drawn over here. So we have an accounts payable T account that, remember, we credited for $7,000. I haven't paid them yet, but now that I've returned this TV for $600, I'm going to debit accounts payable to reduce how much I owe them. So now I'll say, oh, look, when I pay you, I'm only going to pay you $6,400. That's all I owe you now. And I'm going to credit my inventory account because I returned that inventory. So here again, I have my inventory T account over here that I originally debited for $7,000. Now I'm going to credit it for $600 to say, hey, look, I only have $6,400 worth of TVs now. So my journal entry, when I return something that I bought, this is what we call a purchase return. Purchase return was I'm the buyer and I'm returning something that I bought. I will debit accounts payable and credit inventory. Now we're finally going to get back to that 210 net 30. Remember, we were offered terms 210 net 30 and we haven't talked yet about what that means. So sometimes sellers or suppliers will offer us a discount if we will pay our account early. And that comes across as that 210 net 30, or sometimes it's 115 EOM or something of that nature. And that shows the amount of the discount that we are offered and what the terms are in order to get that discount. So the first number we see is always the percentage of the discount. So in this case, it's a 2, so it's a 2% discount. If it was a 1, it would be a 1% discount. If it was a 3, it would be a 3% discount. So the 2 is the 2%. The number after the slash is how many days we have to pay to get the discount. So this means we get a 2% discount if we pay our bill in 10 days. If it were 115, it would say we would get a 1% discount if we paid our bill within 15 days. And then after the comma, this tells us how long we have to pay the bill if we're just going to pay the full amount. So if we pay within 10 days, we get a 2% discount. Otherwise, the entire bill is due in 30 days. Sometimes it will say 210 EOM. Instead of net 30, it may say EOM. That means end of month. So we have a 2% discount if we pay within 10 days. Otherwise, the entire bill is due at the end of the month. So remember that we only owe $6,400 in accounts payable right now, right? Because we returned that $600 worth of stuff. So if we get a 2% discount, if we pay within 10 days, we're going to get a $128 discount. Okay, so that 6,400 multiplied by 2% or 0.02 says that if I pay within 10 days, I'm going to get a $128 discount. Well, I don't know about you, but I'm not going to turn down a $128 discount. I'm going to pay within the 10 days so I get that discount. So the discount comes out as a credit to inventory. So let's think about this for a minute. Let's jump down here and look at the journal entry, and then we'll discuss this. So when I pay the bill, I have accounts payable that's sitting over here. I'm going to draw my accounts payable T account real quick. Remember, it had a credit balance of $7,000 and I debited it for $600, which means I have a credit balance of $6,400. And the same thing with my inventory T account. I have a debit of 7,000. I credited it for 600 when I returned that inventory, and now I have a debit balance of 6,400. Remember, inventory is an asset, and assets are always recorded at their historical cost, meaning how much I paid for them. So here I am getting ready to pay my bill. Assuming I pay within 10 days, I'm going to credit cash. Now, I owe $6,400, but I'm getting a $128 discount. So 6,400 minus 128 means I'm going to write a check for 62.72. Now, normally when I pay my bill, I'm going to debit accounts payable, and that's what I'm going to do here as well. But I want to debit accounts payable not for 62.72. If I debit accounts payable for 62.72, it's going to show that I have a $128 balance in accounts payable. It's going to show like I still owe them money. I don't owe them any money. I'm zeroing my account out. So I want to debit accounts payable for the full 6,400. So over here, now my T account is zeroed out. I owe them zero money. But remember, debits have to equal credits, and right now they don't. I'm missing a credit of $128. This $128 is the amount of the discount. But remember, assets are recorded at their historical cost, and right now I'm showing inventory is recorded at $6,400. But that's not how much I paid for it. I paid $62.72 for it. So I need to credit inventory for the amount of this discount to show now my inventory is really at the amount that I actually paid for it. So now my inventory account is correctly reported at its true historical cost. I've zeroed out accounts payable, and then I've written my check for the amount of my discount. So let me erase this real quick. And now I can see my journal entry here. Notice that we did not take a discount on the $600 of goods that we returned. That's because we had not paid for them yet. All right, now remember also that inventory is an asset, and assets are recorded at their historical cost, which means what I paid for them. But that includes everything I have to pay to get the asset ready for its intended use. So if I have to pay sales tax, if I have to pay shipping, if I have to pay anything like that in order to get the inventory and get it ready to use, then that goes into the cost of the inventory. So here we told I had to pay $300 in freight and shipping fees. So I'm going to debit inventory for that $300. That is included in the cost of buying the good. And think about it, if you buy something online, let's say, the cost to buy it is not just the sticker price. It's the sales tax, it's the shipping cost. I mean, all of that goes into how much you're paying for that good you're buying. Same principle applies here. Now, let's look at it from the seller's perspective. When we are the seller, we record the sale when we transfer the goods to the buyer. When we give up control, that's considered we have earned the income. We've earned the revenue, so we then get to record the revenue. The revenue can either be for cash or it can be for accounts receivable. We can sell it on account or on credit. So under the perpetual inventory system, every time we make a sale, we have to make two journal entries. The first journal entry is to record the sale. We already know how to do that. That's debit cash or accounts receivable, credit, revenue. And then we're going to do a second entry to move those goods out of inventory into cost of goods sold. So we'll do a second entry to debit cost of goods sold, credit inventory, so that our inventory records are always updated. So here we're told we sold a TV for $950 on account to customer Jones. We're offering customer Jones terms 210 net 30. and assume the cost of the TV is $600. Now, let me caution you, one of the hardest things is figuring out who you are in the transaction, because the transaction is different if you're the buyer or the seller. So the first thing you want to ask yourself is, who am I here? In this case, we are the seller, so we know that we have to do two journal entries. Number one, we have to record the sale and account for $950. And then number two, we have to do an entry to move those goods out of inventory into cost of goods sold. So I'm going to encourage you to pause the video here, practice, try to do these entries, and then restart it and listen and see if you are right and listen to the explanation. Okay, so hopefully you're back from your pause. So our first entry is we want to debit accounts receivable, credit sales. Sales is a revenue account that we typically use when we are selling a good. Okay, so you may see it called sales revenue or just sales, but typically when we're selling a good as opposed to a service, we'll call it sales. So we know that it's accounts receivable because the sale was on account here. And on account, I'm the seller, so that means I'm going to receive it. So I'm going to debit accounts receivable, credit sales for $950. Then I'm going to do a second entry to debit cost of goods sold, credit inventory for the $600 to move those goods out of inventory into cost of goods sold. Remember, this entry is always for the amount that I paid for it, not what I sold it for. Now, sometimes the buyer, when we're the seller, may decide to return some goods, and that's called a sales returns, or we may have a sales allowance. Okay, so a sales return and allowance is a contra revenue account. We've talked about contra accounts before. Contra means opposite or offsetting. So this contra revenue account is going to offset revenue in the income statement. It does have a normal debit balance because it's the opposite of sales revenue, which has a normal credit balance. So here in this example, we're told a customer returned a TV that had a $950 selling price. It was purchased on account, which means accounts receivable. And remember, the cost of the TV is $600. So since we did two entries when we sold it, we have to do two entries when there's a return. The first entry is to record the sales return. So we'll debit that contra revenue account, sales returns, and then we'll credit accounts receivable to reduce how much the customer owes me. So I'll debit sales returns and allowances, that contra revenue account, I'll credit accounts receivable. Now I've reduced how much the customer owes me. Now, assuming the good can be resold, I'm going to put it back into inventory. So again, I'm going to do the opposite of what I did when I sold it. I'm going to debit inventory, credit cost of goods sold. Now, the sales discount is a second contra revenue account. So we have two contra revenue accounts. This records the amount of the discount. So remember how we offered a customer terms 210 net 30? That 2% discount is now going to come in a sales discount. So again, if we're the buyer, the discount goes through inventory. If we are the seller, the discount goes through sales discount. So again, you've got to ask yourself, who am I in this transaction? Okay. So let's say that the customer paid us within 10 days. Let's say that they didn't return the item, so they're just going to pay us. They owe us $950. Let's go back and look at our accounts receivable account. Remember, we debited accounts receivable for $950. But because they get a 2% discount, they're not going to pay us all $950. So 950 times 2% equals 19. So they're going to get a $19 discount. So they're going to write me a check for $931, but I'm going to credit their account for the full $950. So that means that $19 discount is going to that contra revenue account, sales discounts. Now, if we collect sales tax on our goods, then that is a liability because we're required to forward that to the state government. Even though we're taking it from the customers, we don't get to keep it. We have to turn around and remit it to the state government. So if there's, let's say, a 5% sales tax, then for one TV at a selling price of $9.50, that would means we would collect an additional $47.50 in tax. So that means the total amount of cash that we would receive from the customer would be $997.50. We're only going to record $950 as revenue, and the other $47.50 is a liability that we owe to the government. So here we can see we're going to increase cash for that 997.50. We're going to credit sales for just the 950 sales price, and then the rest of it goes to that liability account, sales tax payable. So these are the entries from the buyer's perspective and the seller's perspective. It's really important. I'm going to encourage you before this next test, make a really good cheat sheet to use on the test. So make really good notes because it's real easy to get confused as to whether you're the buyer or the seller and what journal entry do you need to make.